This session is about the subject Corporate Structure and Administration for BCom first semester students on Unit 2 Capital of a Company. In this session, I'll be covering the most likely questions in your examination. In section A, you can expect these questions. What is capital? A capital consists of all kinds of wealth which is obtained other than gifts and which generates or yields income. It generates income either by investing in a business or in different income property. There are common types of capital such as debt and equity. What is a share? A share can be defined as a fractional part of a capital which forms the basis of certain rights of a member of the company, as well as his liabilities as against the company. In short, the total capital of the company is divided into smaller parts, and each part is considered as a share. What is share capital? The term share capital refers to the amount of capital raised by the company through issue of shares. The share capital can be raised either by issuing equity shares or preference shares. There might be a question, what are preference shares? Preference shares are shares which have preferential rights in respect of payment of dividend during the winding up of a company as well as during the existence of the company. And the repayment or refund of share capital in the terms of winding up will be first made to preference shares holders. What is demat account? As you remember, demat stands for dematerialized account. Demat account is an account offered by a bank for its beneficiaries for holding securities, just like account for funds. Demat account reduces brokerage charges, making transfer of shares easy and enables quick trading, which includes both buying and selling as well as settlements. What do you mean by book building? Book building is a process of generating, capturing, and recording investors' demand for shares during initial public offer or other securities during the issuance process in order to support efficient price discovery. In short, book building is a process by which an underwriter attempts to determine at what price to offer an IPO based on demand from institutional investors. Let's move on to the most likely questions in section C, which will be asked for 15 marks. What do you mean by equity share capital? Mention or state its advantages and disadvantages. Firstly, you need to explain meaning of equity shares, then advantages and disadvantages. Equity shares, they are the main source of finance for a firm. It is used to the general public. Equity shareholders do not enjoy any preferential rights with regard to repayment of capital and dividend, but they are entitled to residual income of the company, but they enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of the company. You need to write the advantages. We will discuss advantages firstly from the point of view of shareholders. Equity shares are very liquid and can be easily sold in the capital market. In case of high profits, they get dividend at a higher rate. Equity shareholders have the right to control and manage the company. The equity shareholders get benefit in two ways: annual or yearly dividend and appreciation in the value of their investment. Let's understand the equity shares advantages from the point of view of company. They are the permanent source of capital and as such, they do not involve in repayment liability. They do not have any obligation regarding payment of dividend. Larger equity capital base increases the credit worthiness of the company among the directors, creditors, and investors. Now, what are the disadvantages or demerits of equity shares? Let's discuss even this from the shareholders' point of view first. Equity shareholders get dividend only if there remains any profit after paying debenture interest. tax, and preference dividend. Thus, getting dividend on equity shares is uncertain every year. Equity shareholders are scattered and unorganized, and hence they are unable to exercise any effective control over the affairs of the company. Equity shareholders bear the highest degree of risk of the company. Market price of equity shareholders fluctuates very widely, which in most occasions reduce the value of investment. Issue of fresh shares reduces earnings of existing shareholders. Disadvantages from the company's point of view. Cost of equity is the highest among all the sources of finance. Payment of dividend on equity shares is not tax deductible expenditure. As compared to other sources of finance, issue of equity shares involves higher flotation expenses such as brokerage, underwriting commission, and other charges. The next question which you can expect in section C is, what are debentures? Explain the features and types. So you need to remember to write the definition. The term debenture is derived from the Latin word debere, which means to own a debt. So therefore, the definition of debenture is a document issued by the company as an evidence of debt. It is the acknowledgement of the company's indebtedness to its holders. Next, you have to write the features. Debentures holders are entitled to periodical payment of interest at an agreed rate. They are also entitled to redemption of their capital as per the agreed terms. They have no voting rights. The debenture holders do not interfere in the management of the company. You need to write the classification. Since it is for section C, you can write the two bases. Debenture on the basis of registration, which is of two categories: registered debentures and bearer debentures. The debentures which are payable to the registered debenture holders are called registered debentures. These debentures are not transferable by mere delivery. The names of the holders of these debentures with the details of the number, value, and type of debenture held are recorded in the register of debenture holders. Registered debentures are not negotiable instrument. So in your examination, please underline negotiable instruments. Transfer of such debentures requires registration. The next type is bearer debentures are those which are payable to the bearer. These debentures are transferable by mere delivery. The register of debenture holders does not have the names of the debenture holder recorded. Hence, they are transferable by mere delivery. Registration of transfer is not necessary. Bearer debentures are also called as unregistered debentures. The next is debentures on the basis of priority, which is of two types: preferred and ordinary. The debentures which are paid first at the time of winding up are called preferred debentures or first debentures. They are just like preference shares. Ordinary debentures that are paid after the preferred debentures during the winding up of a company are called as ordinary debentures. This session would have helped you in learning section A, most likely questions, and section C. So hope this session would have helped you. If you have liked this session, please remember that education is the most powerful weapon which you can use to change the world. Thank you so much.